Hello and welcome to this very special edition of CNBC Pro Talks. I'm Tanvir Gill and we are live. We are live at INSEAD's Asia campus here in Singapore, and we'll be speaking to a very special panel of guests about their outlook for the markets, for the macros, for the coming year, that is 2024. I just want to thank all our subscribers for sending in questions from across the world. We'll be posing those questions to our panelists in just a moment. We'll also be taking questions live from our audience present here. I just want to do a quick round of introductions before we dive straight into this discussion. Just want to introduce our panelists. Jenny Zeng is CIO APAC Fixed Income at Allianz Global Investors. Jenny, say hi.
Hi, everyone.
We also have Brian Arcese, who's the fund manager at Ford Asset Management. Brian, of course, manages more than $1 billion across his multi-asset portfolios. And then, of course, we have James Sullivan, who is head of APAC Agri Research at JPMorgan. So, yeah, wonderful to have all three of you here. So glad that you could make the time to do this for us. I just want to, highlight just at the very outset, we are running a story on CNBC.com as we speak right now, which is on the front page, that talks about how geopolitical uncertainty and instability, as well as a packed election calendar, has many strategists quite wary of 2024. So, James, I want to start off with your thoughts on how you're landscaping your 2024 view on the back of that.
Thanks very much for having me on the show today, Tanvir, and thanks everyone in the audience. So if I take the question in reverse order and deal with elections and then geopolitical risks, from an elections perspective, I think it's important to note that more than 40% of the world's population is going to elect someone this year. It's the highest level that we've seen in a very, very long period of time. That has very specific bottoms-up impacts on consumer spending, investment trends, et cetera, in most of the major countries around the world. And so I think the critical thing for investors to do is to take the step back, do the bottoms-up fundamental analysis to understand exactly how that is likely to be exhibited in each of the countries in which they're investing. It will have very clear bottoms-up impact on multiple indexes, multiple sectors, and multiple countries around the world. And it just takes the time to come back and do the work and understand how that will differentially affect that environment. From a geopolitical risk perspective, ultimately, from my perspective, it's about understanding what's in the price versus the array of alternatives. I think it is next to impossible to predict the future as it regards geopolitics with any level of specificity. The amount of data points, the amount of history, the amount of knowledge that would be required is not something that I possess. And so understanding the asymmetry of risk that exists in markets, how much risk is priced in, again, versus the range of outcomes. If an extreme amount of risk is priced in, it's actually a relatively easy decision. If there is no risk priced in, it's an easy decision. The challenge is when you're in the middle and understanding what bets, what risks you're willing to take with your investors' funds at differential levels of geopolitical risks as exhibited in market pricing.
Right, Jenny, same question to you. Opening thoughts in terms of how you're formulating your 2024 strategy.
Yeah, I want to really get back to the election question you just asked earlier. Exactly, because it's critically important for 2024. We haven't seen such a heavy election year for many, many years, right? So in emerging market, there are 17 countries that are going to go through elections in the next 12 months, not including some of the frontier countries. And I already started to see some of the early impact on fiscal discipline, for example, in Poland and Mexico. They started to lose the physical disciplines that we've seen over the COVID period, actually supported emerging market narratives. It's not our base case that we think a lot of other emerging countries will follow Poland and Mexico, but this is definitely physical discipline. It's definitely an area from a fixed income perspective that we need to watch, right? Now, in Asia specifically, we will have Taiwan, we have Indonesia, and we have India, we have Pakistan as well.
Bangladesh too.
Yes, you're right. So,
and these are high growth economies we're talking
exactly,
about, right? So it really matters in terms of what happens on the fiscal policy side to boost growth.
Exactly. But one thing I want to talk about Asia is that compared with other emerging market countries, in fact, we see more policy continuity in this region despite the election. So therefore, the range of outcome, I really like that term. It's a very credit term. should be much narrower here in Asia, and we have a little bit more visibility in terms of policy direction there. So we remain quite positive, for example, for Indonesia and India on their local bond market side.
But what does that mean in terms of return expectations, Brian? Because you're obviously managing a multi-asset portfolio, right, over $1 billion. What do you tell your clients? How are you thinking about return expectations going into the new year? Because we've already seen 2023 deliver spectacular returns.
We have. I think we look at it in a handful of ways. I mean, if you look at returns, if you take the U.S. specifically and look at returns during a presidential election year, they've tended to be quite good. But within that, much of the return happens after the election result is known, really regardless of party. And I think that we all know intuitively that what markets dislike most is uncertainty. And so I think not only in the US, but in economies and markets more broadly through the year, we're setting ourselves up for a bit of volatility because there will be a lot of uncertainty. I mean, to James's point, handicapping presidential elections is incredibly difficult, right? Handicapping geopolitical conflict is incredibly difficult. And so what we try to do, we don't view ourselves as portfolio managers as much as we view ourselves as risk managers. Yeah. So you have to take risks somewhere, and you have to look at the landscape and what the opportunity set is, and take risk where you're being compensated. So as James said, you do the bottoms-up fundamental work, where the valuation is at the discount enough to compensate you for taking that risk, then it's a reasonable risk to take. If it's too high, then it's a risk that we would shy away from.
So James, is the risk taking ability going to be stronger for Asia next year, given that obviously there'll be so much focused on the US election outcome, UK election outcome, but at the end of the day, those markets have already done very well. The US has, pretty much been on a tear all of this year. We are 4,500 for the S&P and beyond. So does that shift the focus? Does that shift the risk balance towards Asia?
It's a great question, and I'll address it maybe in a couple of different ways. To expand on Brian's concepts, the two phrases that they use that I identify with the most is risk manager, not risk avoidance, and risk when you are compensated, which touches on your point regarding what's already in the price. And I think the challenge for the U.S. market in particular right now is the U.S. equity market in particular, and I'll let Jenny comment on the credit markets, but the U.S. equity market in particular is trading as though the laws of economics no longer exist. And we can deal with this in more detail either in question and answer or in our conversation. But there are multiple levels where we just don't see that as being the case. And this idea that we've had 525 basis point of rate increases and that hasn't triggered a reduction in CapEx, that hasn't triggered a reduction in consumer spend, there are reasons for that. And the biggest is that 525 basis point of rate hikes have been paired with 3.7 percentage points of GDP increase in fiscal thrust. The U.S. government has thrown a ton of money at the U.S. economy over the course of the past year. The challenge in terms of potential return profiles moving forward, the U.S. has traded very well. And as I look forward into next year, 3.7% positive thrust becomes 1.5% negative thrust. And so you will absolutely clearly see a mathematically driven decline in the momentum of the U.S. economy as we start to go into 2024. And again, markets are a game of expectations versus reality. The reality is that we will see that economic slowdown. The reality is that expectations are baking in, at the moment, a 5% top-line growth, 50 basis points of margin improvement, and we're at peak margins in many U.S. industries right now, which combine to drive a 12% bottom-line growth expectation. That's a very punchy set of expectations for the macro environment that we've just described.
So you said economic slowdown. So does that mean that the U.S. has conclusively averted a recession?
It doesn't necessarily have to meet the technical textbook definition of a recession, but the idea that you will see an incremental slowdown in the rate of economic growth, I think, is very clear. And if you look at that on a segment-by-segment perspective, one key thing that we've taken some time to try to point out from a JPMorgan perspective is the consumer spending story. That has been a key surprise as we've moved through 2023. From our perspective, this is explainable. The first half, or two-thirds of the conversation, was driven by significant excess savings that were built up during the COVID period, and in particular, a shift in the type of spending that occurred towards goods and away from services. You're now seeing those excess savings being drawn down, and the savings spent not on goods, but increasingly on services. The next leg of that conversation is the wealth effect from rising U.S. real estate prices and a very strong U.S. equity market. In particular, the latter is a positive and negative flywheel. While the market's going up, I feel the wealth effect and I spend more, which drives the market higher, and it's self-affirming. That also occurs on the way down, however. And so if the U.S. market starts to crack as we get into the new year, and we can talk more about the timing of that in a second, we do expect that that negative flywheel will start to kick in, and consumer spending in particular will be a leading indicator of that.
Okay, interesting. We'll talk a little bit more about, the possibility of a recession, soft landing going into 2024. But Jenny, I do want to get your thoughts on the fixed income side, because you're saying that going forward, the focus, or rather the interest, would be more for U.S. Treasuries versus equities. So to the point that Brian was making, that equities have had their run, do you think now it's going to be the time for fixed income, U.S. fixed income, to take over?
Yeah, let me take a step back first, look at the state of the U.S. economy at the moment. I think James has already alluded to. If we look at the latest data, right, like the third quarter U.S. is growing at, is thriving at 4.9% on an annualized basis. Yes, we tend to agree that it will be naive to assume after like almost 500 basis points of very sharp increase of rates, nothing happens. But yet, there are reasons, as James just said, why the U.S. economy has been doing so well so far, and inflation is still way above target. And I want to talk a little bit more on the inflation side, because there are some structural factors that are very hard to come down, to be very honest, right? For example, wage inflation. I'm sure that everybody read in the news that no matter it's from Detroit or from Hollywood, and then the labor unions managed to won deals that's inflationary pay upgrades. So those all goes into the wage inflation. It's not that easy to come down. And also the years of that undersupply in the housing market in the U.S. is also likely to keep that part.
An element of complacency coming in there, that those 525 basis points of rate hikes have done their job in terms of taming inflation, or is there, because it's the direction, right? And directionally inflation is going down, so everybody's like, do the absolute numbers matter? I mean, do they have to get into that comfort zone of 2% or sub 2% on inflation? Or is the glide path enough?
This is spot on the question. The thing is, I would think that Fed it's going to face with two difficult decisions for next year, particularly given it's election year. One is to accept, okay, inflation is going to run higher than target for a prolonged period of time. The second option is they need to hike much more so as to almost engineer a recession so as to bring inflation down. Right? Given it's an election year, I would think it will be sensible. Exactly, right? It will be more sensible for Fed to say, okay, let's focus on growth and employment, even though that means that inflation is going to run longer, higher for longer, right? So which means coming back to your very first question, you said, what about the rate cuts, right? So I think the market is still pricing way too much cuts, and the market is still not serious enough about this higher for longer narrative.
No, but my broader question was, is it the time to get into U.S. Treasuries right now? And what end of the yield curve would you be targeting, the short end or the longer duration? Because longer duration is not getting much love.
So, great question. From a relative value perspective, I do think it's time to start to add duration in your portfolio for two reasons. The reason one is from a relative value perspective, it does look better versus the equities. We have repriced, and the yield outlook is at a level that many of us, particularly in fixed income, has been dreamed for years after 2008, right? So from a relative value versus history perspective, it's time to add a bit of duration in your portfolio. Secondly, I do believe that from next year, now we have repriced, the U.S. Treasury should resume the role in the portfolio, for example, for Brian, as a recession hedging. That role was almost non-existent since 2008 because the absolute yield was so low, right? So for those two reasons, I do think it makes sense to start to add duration in the portfolio, but we need to be methodical.
James, before I come back to you, Brian, where does that leave the tech story? Because we've spoken about U.S. equities largely. We've touched upon that. We've touched upon U.S. credit, U.S. fixed income. But within equities, we know that the story has really been about the Magnificent Seven, Mag 7, right? And the rally has been skewed to some of the high-quality tech names. And so do we broaden out? There was a guest on the show earlier on today on Street Science Asia talking about how this could be, 2024 could be the year for mid-caps and small caps. Do you see it as that, or do you see it to be a little more balanced? I mean, how would you asset allocate in the coming year?
Yeah, so I think from a I guess maybe taking it very briefly top down and then looking at the technology sector in particular, we do agree that for the first time in quite a long time, fixed income can play a proper role as a hedge in the portfolio. So if you look at our multi-asset portfolio, we've gone from 0% fixed income at the beginning of 2022 to now close to 20% of the portfolio.
Specify fixed income.
So largely U.S. Treasuries. So beginning sort of mid last year and more aggressively as we moved through the year and moved through this year, short duration. But now, I mean, we agree with Jenny's point. We've been also extending duration. So that for the first time offers a real alternative, right? No pun intended, but I mean, you can earn a real rate of return, finally, in an asset that is theoretically risk-free. Right? So, and then moving to your point on the tech sector in particular, because it obviously is linked to rates as well. I mean, a lot of the performance of the tech sector relative to the rest of the equity market, at least a portion of it, has been earnings driven. I mean, we wouldn't want to take anything away from the fact that these are very high quality companies that are growing earnings, at least at the basket level, at an incredible rate. That being said, in our view, we think that expectations have now reached a level where they're too high, given where valuations are, to be putting fresh capital to work kind of in that space. We are underweight. We're not underweight tech, but we're underweight Magnificent Seven. Okay. We're underweight expensive U.S. tech, and we would be overweight some select Chinese technology names, for example, where we see, to be honest, the same growth, if not better growth, but at valuations that are far, far less expensive.
Okay. Before I talk about China, you give me the cue for the next topic. You wanted to come in and make a point on on what Jenny was saying, James.
I think there's a commonality across a lot of the conversations, and it ultimately comes down to a very simple concept, which is ignore the headline and do the work. And I think what we're seeing in index after index, country after country, macroeconomic forecast after macroeconomic forecast, so to deal with the inflation conversation, the analytical error is to apply trend analytics to an idiosyncratic singular event. And so you had COVID, and we're now trying to apply trend analytics to the aftermath of COVID without recognizing, again, ignore the index, do the work. You have the cross current of supply chain dynamics coming off, which is reducing inflation, while at the same time, Jenny was talking about the pressure in the labor force. Ultimately, you've seen this massive increase in labor force participation. Female labor force participation in the United States has never been higher, and it will be difficult for it to continue to go. Male labor force participation is now above cycle highs. And so you've seen this dramatic force, which has actually reduced wage inflation structurally, which is falling by the wayside. So you have all of these cross currents that absolutely matter. You're talking about the U.S. The U.S.'s index is up off of 7 stocks. One of the issues that we have talking with investors a lot is this concept of the China market is bad from an equities perspective. Okay, China AI stocks are up 60%, right? You have multiple segments within every single index in Asia that has achieved significant bottoms-up idiosyncratic performance if we ignore the index and do the work.
Yeah. You know, it's interesting you're saying that. I was just looking at, before I, of course, open the floor for questions from the audience, I just want to take up one more aspect, one more theme that obviously is going to dominate 2024, which is what happens with global rate policy. When do we see the first rate cut? I've had JPMorgan come out with their note. They're essentially predicting that somewhere in the second half of the year is when the first rate cut happens. Goldman Sachs is saying end of 2024. And Morgan Stanley is saying June of 2024. So there's a dispersion out there, and it makes me very confused about the whole situation, because we have students sitting out here, right, who may have taken student loans, and they're watching what's happening with rates. And, this will be music to their ears in terms of when the rate trajectory reverses. So what do you have to say about that? I'll start with you, Jenny, very quickly.
So Allianz GI, we expect the rate cut to happen in July next year, the first rate cut will be happening in July next year. Now, it doesn't really matter whether it's July. To be very honest, it's July or August. I mean, we need to watch the data at the end of the day. That's what the Fed is doing. We need to see how the economy is doing, whether inflation is going to stuck at a certain point, or inflation actually is going to come down to the target, right? But at the same time, yes, everybody's mortgage is going up, but your time deposit is also going up, right? So as Brian said, as I said, for a long, long time, that we can finally own something which is considered risk-free. We can debate on that, but for more than yes, we can debate on that, but for more than 4%, right? So there's always another side of the equation here.
So July 2024 is your call.
That's July's my call.
Your call is obviously JPMorgan's call, which is sometime in the second half
Never different.
of 24.
No, but look, again, the challenge is the analytical underpinning of the call, right? And the analytical underpinning is a decision tree with severe bifurcation, right? JPMorgan view at the moment is that we have a 40% chance of a soft landing, which will allow for rate cuts somewhere in the second half. Kind of pick a month. It doesn't necessarily matter unless you're short-term trading. We have a 60% chance, however, of the boiling the frog scenario, right? And the boiling the frog scenario ultimately comes down to the idea that you have all of these cross currents, which at the moment are offsetting, which become directional as we enter 2024. And so wage inflation actually accelerates, not decelerates, because I have no more people to pull into the labor force. And that's been a primary dampener. I have goods inflation at the moment that is being dampened by primarily German and Chinese overcapacity. We'll see what happens with that in terms of incremental trade flows. And I have services inflation, which by definition will creep up because it's very difficult to ramp service revenue without the creation of more people, which takes a little bit of time. So again, we have all of these cross currents, and I think it's critical to note that within that forecast, there's a 60% chance that we end up at the end of 2024 with no rate cuts. And so one of the critical things that we're talking to investors about is, again, the psychology of this conversation. If you're a central banker today, you know what Jenny has talked about, you know what Brian and I have talked about to some degree, which is that the future is uncertain and it is very bifurcated, in which case the vocabulary that I will use will continue to be extremely cautious. So you have central banks around the world that will tell you a very cautious story. Here in Asia, we think we still have rate hikes to come, not rate cuts, because of the interest rate differentials, which are at an all-time high between EM Asia, in particular in the US. So the commentary coming out of central banks is going to be interesting to watch. One thing that we debated a little bit is whether, because we can all forecast it will be conservative, if we all just ignore it. Which will be interesting to see, because there's still informational value in what these folks are saying.
That is very interesting, the point that you made that Asia is not done with rate hikes. We'll come to that in a bit. Brian, your thoughts on the first rate hike from the Fed? Because the thinking largely is that no other central bank would blink till the Fed does on rates.
Yeah, so in our view, it's very much path dependent. And I think what we've been trying to work out is to position the portfolio in a way that it can do reasonably well in a scenario where economic growth is strong enough or inflation is persistent enough that you don't end up with any rate cuts by the end of next year, right? But also position in a way that we can benefit, or at least the portfolio is protected, if the economy falters. If inflation does come back down to target far more quickly than what investors are kind of currently expecting, which gives the Fed much more cover to ease. So in our base case, we do have a 50-50 chance basically of a rate cut sometime in the second half of next year. But I think, to be honest, it's even for us, it's still very uncertain. I mean, there are a lot of cross currents, I mean, to use a term that James mentioned. And you could end up in really either scenario. So that's why I think from an investor standpoint, you really need to do not only the bottom-up work to figure out what you think is your own base case, but to figure out, okay, these are the 3 or 4 probabilistic outcomes and what the result will be of those outcomes, and then position accordingly.
You know, your views have confused me. So if the investment strategists are so confused about what's going to happen, or you know, the uncertainty is so stark, then it's difficult for somebody to actually ascertain what's going to happen next year. And I think that's something that we need to kind of take on board at this point in time. James, I'll let you come in with your point and then open the floor for questions.
Yeah, and so I think the critical dynamic, at least from our perspective, is to identify what's in the price and the asymmetry of risk, because the outlook is uncertain and we don't know where it will land. But if I can know that the market is so skewed and positioned this way, then that opens up investment opportunities. And so the base case scenario for JPMorgan and for myself is that you do get a Christmas rally in the US primarily. That Christmas rally fully prices in the Goldilocks scenario in the United States, which creates an incredibly difficult incremental investment environment in the US, because I've now put the asymmetry on this side. Very different outlook if you're looking here in Asia, where no one owns China, expectations are rock bottom, and you've already seen very strong performance out of certain subsectors, And again, you're going from fiscal thrust to fiscal drag in the United States. In China in October, you got 80 basis points of GDP of fiscal thrust. We expect another 80 basis points out of the PBOC by the end of this year. So very different operating dynamics, and it ultimately comes down to that asymmetry of what's in the price versus the risk profiles that we're looking at.
Speaking of China, Goldman Sachs is saying that they're expecting Chinese stocks to make their first annual gain in 4 years in 2024. So we'll have to wait and watch out for that. Let's just open the floor for more questions. Let's have audience questions as well. Could you raise your hands? All right, please. Announce your name and take your question.
Is that audible?
Yeah.
Hello, I'm Ankita. So I was listening to your views, and very interestingly, as we talk of the Goldilocks, we also see the dollar index, which is easing down, is now at 103 this morning. Any more space that it creates for the emerging markets? If it does, which economies, which sectors specifically, if we move away from tech, and also other assets in the portfolio? Can we talk more on maybe gold, commodities? So if assumingly for a moderate risk appetite, if I were to do asset allocation for 2024, what would it look like?
Brian is the asset allocator here.
Okay.
Well, how much would commodities be a part of your portfolio? And gold as well, because I know that you're bullish on gold.
We are. I mean, I think so. So if you look at gold in particular, I mean, we don't invest in gold as a hedge against inflation. It hasn't proven over time to be a great hedge against inflation, but it is a good hedge against volatility and against geopolitical risk. And over time, we see geopolitical risks increasing, not only in 2024, but over the long term. So for us, gold is at the moment sort of 6 to 8% of the portfolio. Commodities, so directly held commodities, for us are really limited to gold in the fund construct that we have. We can't invest in commodities directly. But that being said, about 15 to 20% of our equity portfolio is invested in equity or commodity-linked equities. So high quality, either energy companies, for example, high quality copper miners, for example. And that's where we're basically playing a balance. I mean, in our base case, we do end up in an economic slowdown next year. So we often get questions from investors, well, if you believe that we're going to have an economic slowdown, why do you have 20% of your equity portfolio in commodities? We invest in commodity companies that generate a lot of cash, sort of, I mean, even at commodity prices far lower where they are today, but we also have to the position for the portfolio for the fact that we can be wrong, right? The economic growth or inflation can continue for longer than we expect. So it's not only direct investments in commodities that can offer that hedge against inflation persisting, but equities as well. I mean, equities in general are a hedge against inflation over time, but commodity-linked equities are obviously more of a real-time hedge against inflation.
Would you agree, James? Commodity risk for 2024?
I would, and I think that sort of the traditional maximum, particularly from an emerging Asia perspective on the equity side of the house, is that ultimately a strong dollar is difficult for emerging equities to outperform. And so if you do get a weaker dollar, that's better for the complex as a whole. You obviously have direct linkages with exporters around the region, and you've seen that very clearly, particularly with Japanese exporters, given some of the yen weakness here to date. And so it will absolutely have an impact on a sector-by-sector, country-by-country perspective, but a weaker dollar would be positive for EM equities.
I just want to stretch that point that Ankita made, because in a global risk survey carried out among 130 businesses last month by Oxford Economics, almost 40% of the respondents said that they viewed the Israel-Hamas war as a very, very significant risk to the global economy over the next 2 years and something that could disrupt the oil markets. So, Jenny, how are you thinking about that as a fixed income investor?
Before I answer that question, I really want to come back to what the local currency, the currency question, because that's incredibly important from a mid to longer term perspective. I do believe we're moving to a multi-currency world from now. This can be a regime shift for this region. And this is the thing, if you look at the Asian economies, this round of the Fed hike, how resilient it has been. right? In the past, so as for any emerging market assets class to perform, we need to have weaker dollar, we need to have weaker oil price, we need to have OECD countries not in recession. But if you look at this round, in fact, and this is the reason why majority of the emerging market economies were capped in terms of their potential growth. But if you look at this round, I think for the first time ever that Asian countries are able to grow at its full potential because they're all developing their own local markets. They started to fund their long-term capital needs from their local currencies. And if you see their currency vol has come down significantly, that will lead to repricing. No matter it's equity, multi-assets, or fixed income, housing, I mean, I don't know, like, you know, all the assets prices in those countries. So that's incredibly important, that the question you asked. Back to your oil question, right? There's always a demand and a supply side of the oil. I'm not a commodity expert, but if I look at the supply side, I don't really see the supply side issue can be easily solved in the foreseeable future. Then the thing is on the demand side. Whether we're going to see growth next year in China, for example, India, for example, the United States. But overall, if I look beyond the very, very near-term volatility, I see that oil staying at where they are at the moment. At least I don't see oil coming down.
Okay. Any more questions? Please raise your hands. Right, the lady in the front row. Yeah.
To follow up on the oil and gas, Anastasia,
Yeah,
class of July 24. So my question is about oil and gas market. So considering the geopolitical situation and the current focus on ESG and sustainability, how do you think that's going to change? And another part of this question is that, would you agree that current focus and emphasis on sustainability and transition to carbon neutrality is actually allowed by high oil and gas revenues? And once oil and gas, the prices hit like $40, the thing's going to change.
That is a very interesting one. James, you had some notes on climate and trade, and maybe you want to just comment on that.
Yeah, no, it's an incredibly important conversation. And I would back up Jenny's comment. Ultimately, if I look at the outlook for oil, it's a supply and demand equation, as it always is. The problem on the supply side is that there's been no exploration and production in I don't know how many years. JPMorgan estimates you'd need somewhere north of 1.7 trillion with a T dollars of E&P funding to get anywhere close to incremental production that would meet economic growth moving forward. And so the balancing act is ultimately trying to look at it from a broader global climate perspective. Is oil and gas required for ongoing economic growth? From an emerging market perspective, I think the answer is relatively clear. If you pump zero oil from here, China's going to burn a lot more coal, and there's going to be a lot of people with a lot of problems, particularly throughout the emerging world. And so I don't think it's realistic to say that oil and gas is going to go away anytime soon, given the structure of the world today. That said, there's some very interesting dynamics going on from an incremental perspective. And if you look at some of the initiatives, particularly in the European Union, to start to put a price to carbon and have a carbon tax on a tradable basis, one of the things that we're looking at is ultimately EM exports to Europe will have effectively a 20 to 25% import duty placed on them as they enter Europe because of the carbon tax that's being imposed. On a relative basis, however, within Asia, China has been an absolute leader in terms of investment in renewable energy, has a significantly greener production platform than most of the rest of emerging Asia. And so one of the interesting conclusions from a global ESG conversation perspective is the potential for China to dramatically increase its share of global exports, not decrease. And so again, watching these cross currents is extremely important. I would agree that supply demand isn't likely to go anywhere. We're forecasting roughly a flat Brent target going into 2024 because of the stickiness of supply given lack of E&P and gradually reducing global growth rates. Again, U.S. will slow, China will pick up, and we'll meet somewhere in the middle.
Right, and where does that leave the whole, the whole thesis about investing in companies with high ESG scores, or essentially meeting ESG targets at a time when rates are high for longer, are expected to be high for longer, there are funding challenges? What happens to those climate change goals, as Anastasia just pointed out?
Oh, I mean, obviously, as rates have increased and financing projects has become much more expensive, we've seen many companies have significant challenges in meeting kind of commitments that had been made prior. So I think that, coupled with the fact that the estimates around the cost involved in transitioning have been really far too low, basically means that transition period is going to be far longer than what's currently kind of priced into markets. But I think if we take it back to that traditional energy sector and your question on oil and gas, and couple it with where fundamentally we feel we're being paid to take risk when we do the bottoms-up work, it's really in that is one of the sectors where I think investors are really being compensated quite well, to be honest, to take risk. I mean, you can buy very high quality, highly cash generative, traditional energy firms at single-digit PE multiples and high single-digit yields. Right? So your level of downside risk there is quite low. Now, they will also be, many of those companies, because they generate so much cash, will also be very imperative to participating in the energy transition going forward as well. So I think that you just have to be, investors should be quite pragmatic when they're doing the underlying fundamental work. It's great to invest in companies that are renewable only, but the economics need to make sense for the company to exist over a long enough period to actually make the energy transition come to fruition.
Yeah, so there needs to be a way in which traditional energy and new energy coexist. Again, more questions from the audience, please? Yes, the gentleman at the back. Give us your name and...
Hi, it's Emanuele here. There's a record amount of corporate debt coming due over the next 5 years. And with the narrative of higher for longer rates, my question is, do you think corporates have enough pricing power to pass on this burden, or can we expect margins to compress over the medium term? Thank you.
You want to take that, James?
What's going to be interesting to watch, again, this Goldilocks scenario gets kind of interesting because you have to assume multiple conflicting things at the same time, which is slightly challenging for most human beings. To your point on pricing power, ultimately PPIs are starting to roll over. You're seeing that in multiple economies around the world. If PPIs roll, that is generally a leading indicator of negative profit margins moving forward. And so that is an issue that we need to be very aware of. The refinancing risks, particularly in a market like the United States, are quite high. Anybody that booked and locked in financing during COVID made a very good decision. But depending on the duration of that debt, and I'll leave Jenny to comment on the specifics, that will be an issue moving forward, particularly in an area of declining pricing capabilities, the lack of ability to push price increases through to the end consumer.
Jenny?
Yeah, well, the credit cycle in the U.S. is clearly in a down cycle, right? If we look at the credit cycle, and then U.S. high yield duration around 4 years, which means 25% will need to refinance next year, each year. And with rates 500 basis points higher, it's naive to assume that the default rate will stay as low as where it is today. Right? So this is exactly what we're saying, like you need to do your fundamental work. And next year, this is the thing, this year everything is driven, there's only one driving factor in the market. Doesn't matter where you do, what do you do, right? It's just U.S. Fed, what the Fed is going to do, how much they're going to hike, when they're going to hike. So from next year on, as both this gentleman said many times already, you need to know where are your risks, where you are going to pick, and what are the companies you are going to invest in. And from a credit perspective, for example, Asian is very different in terms of the credit cycle because we hit the down cycle 2 years earlier than everybody else. So now we're coming out of the down cycle. That's when you probably want to start to allocate some to credit.
But what about defaults? How do you think about defaults?
Yes.
And credit quality at this time?
Yes, so for the U.S., we're literally at the beginning of a default cycle. Right? That's why you started to see the CCCs. There's a spike in CCC default rate in the U.S. already. That's very typical, early down cycle. And because since 2008, the credit cycle has been distorted to an extent that the average default has been artificially low, right? So now we believe that with rates normalizing, the default rate should also normalize. U.S. default cycle around average default rate around 4.5%. Now we're at 2.5, right? We still have 2% to go, while U.S. higher yielding at 8.5%-ish. But in Asia, having said that, we hit that down cycle 2 years from 2 years ago, and now Asian high yields yielding at 12%, which means your realized yield going forward is closer to that yield to maturity now. Right, so that's very interesting.
You're talking about Asian high yield. You're talking about China high yield, essentially, aren't you?
Not necessarily now, because Asian high yield is much more diverse now. Used to be 50% high yield, but now not a single country of risk is more than 30% of the index, right? So you still need to know where you're going to pick, but it's a bargain. It's a bargain hunting game now in Asia.
It is a bargain hunting game. Okay, we have some subscriber questions as well. They sent in some questions too. We have Jiwan from Seoul writing in asking about when do you think the Fed will cut rates in 2024, which we've already addressed. What I want to understand is, when does the market start to price in that rate cut, and what would be the early telltale signs that, okay, this is now perhaps the reason why the Fed would blink or actually decide on the rate cut? What would be that key trigger? Brian?
I think, in what we see, the market is, so the market is pricing in 100 basis points plus, Jenny would know better than I, of rate cuts already. We are also of the view that rates stay higher for longer. So we think that more rate cuts are priced into the market than will actually come to fruition next year. But for us, it's looking at the underlying economic data. And at the moment, we don't really see any reason for rates to come down. So, the underlying economic growth is still quite strong. It is our expectation that it's slowing and that it will roll over.
But it's an election year where the focus is largely growth for the incumbent government. How is it that, the Fed would be allowed to keep rates higher for longer? I don't want to make this a controversial debate, but what I'm trying to say is that at the end of the day, the focus is going to be on stimulating growth, because growth is the vote bank for Democrats, for the Republicans.
Certainly a focus on growth, but also inflation. And I think I don't believe that they'll blink in the near term, even if growth slows, if inflation hasn't come down enough. So I think if inflation remains sticky through the middle of next year.
Inflation has been won. You don't think inflation is going down conclusively, right?
We do actually think, if you look at the shelter component of inflation, at least core inflation, so setting aside, all of the volatile components, core inflation, we do think that by the end of next year is probably quite close to target. But you get there sometime during the second half of next year. But a lot of that is reliant on the shelter component, which is a third of inflation, normalizing. That's still running at 6-7%. So we do think that in the second half of next year, the Fed will have cover to lower rates if growth falters enough, basically. Yeah.
James?
I think you very correctly linked the macroeconomic and the political conversations. The challenge in the United States relative to other countries, particularly here in Asia, is that the power of the purse sits within the U.S. House of Representatives, which is the most contentious arm of government in the United States right now. The likelihood that you're likely to get any major spending bills approved anytime in the near future, the likelihood that you get the actual spending bills approved is not guaranteed. And so the idea that you're going to get a significant increase in fiscal impulse in the U.S. as you go through the election cycle, I think is not very high. And so I think the thing to watch from my perspective is going to be, you've had these cross currents between monetary and fiscal policy over the course, particularly of 2023. We think that those will actually line up symmetrically as we go into 2024. If you do not see a significant increase in fiscal thrust, then I think that the Fed will be allowed to take a very different view, because they're not pushing against the wind anymore. They're operating in conjunction with fiscal policy for the first time in several years.
Yeah, and I think that's something that we need to monitor very closely. That also, the point that you made about funding and spending and fiscal policy, Randy has written in asking about the auctions that have not taken off very well in the U.S. Jenny, you may want to comment on this. He's saying that the 30-year U.S. Treasury auction in mid-November went really badly. Do you think this will scare the Treasury Department into issuing more short-duration debt compared to long duration? If yes, how would this avalanche of short-term debt affect banking stocks and the health of the banks in general?
Well, I really urge, investors or an interested person to focus relatively on the mid to longer term here, because things can change, right? If we had this, should we have this information, this conversation end of October, the market was very, very different. In 2 weeks' time, everything changed. Market expectation, how many rate cuts that has been priced in has changed dramatically. So sometimes we need to be very careful of what the market is telling us, particularly in a situation that there are so many uncertainties, and with the geopolitical election risks on the background. So, but anyway, so from a mid to longer term perspective, that is a critical question for the U.S. Treasury long end. Okay. Overall, we really need to ask ourselves, who will be the buyers of the long end of the U.S. Treasury? And currently, this is also the reason we really like a steepener in the portfolio, because we do believe that
Chinese buyers are out, the Japanese buyers are out. So yeah, that's a valid question.
right. So it's a very, very valid question. So from our perspective, again, back to we just need to build portfolios that we capture our base case, but we hedge our tail risk. And we do believe that having a steepener probably at this point of time is the best way.
What I'm gathering from all three of you is that given the uncertainties for 2024, it's going to be a year where you really have to have very prudent, very well-tailored hedging strategies to really ride through the volatility, ride over the volatility. James?
I think not only hedging strategies, but also the great thing about most of our jobs is that there's a million different things that you could theoretically look at. Our job is to forecast fundamentals better than other people. Our job is to then forecast our view of those fundamentals versus your views of those fundamentals better than other people. But also, I think critically in an environment like 2024 is to just understand the overall structure of the market. And positioning data and positioning skew becomes significantly more important in what we view as primarily a trading market as we go through 2024 because of the noise inherent in the underlying data set.
So we spoke about gold, but Werby from Canada is asking about what would you recommend as long-term safety holdings? Brian?
Long-term safety holdings, I think for us, so when we craft portfolios, our multi-assets in particular, we really view, and this is a portfolio that has been in existence for about 30 years. And the benchmark of the portfolio has always been inflation, so delivering a real return, inflation plus return. Now, for the past 15 years, no one has really cared about inflation plus returns.
Didn't have to, right?
So that it hasn't been a very exciting product to people. But over the past year and a half, obviously, right, inflation all of a sudden, right? I mean, because that's your real benchmark, is delivering a real return. If you can't do that, then you're just eroding capital. Within that, we think that the way to do that is to invest in high quality equities that have strong pricing power, right? Be it by brands, be it by the underlying assets that they own, and to pay a reasonable valuation for them. So it might be a counterintuitive answer, but it's really dependent on time horizon. So, but to me, I think
what have you added to your portfolio, which is an inflation hedge in the last 3 months?
We've had inflation hedges in the portfolio prior. So, I mean, our commodity-linked equities did exceptionally well in a year like last year, for example. I mean, energy and materials were the only two equity sectors.
You know I'm nudging you to give me names, right?
Yes.
Give me stock names.
No, I think so. More recently,
that you've actually taken exposure to.
Two I can highlight. If I need to stock pick, I can. So I would say two, but certainly Total Energies, which is a French oil major, as well as a Roche on the pharmaceutical side. But I mean, because your risk isn't only losing capital, your risk is growing capital more slowly than inflation. So that's why if someone asks me what is a safe or least risky long-term bet, it can't only be the bet that doesn't lose money. You have to take risk. So it needs to be an equity in my mind, but a quality one, and one that should grow at least in line with inflation.
Regionally speaking, James, India and Indonesia, they face elections as well. But do you think that those are regions where one can invest? Are safety bets I mean, in an environment which is largely uncertain?
We do, and for 2024 in particular, we think India is quite interesting. It is relatively well held, and it's not the cheapest market in the world. However, in a global environment of growth scarcity, a major, large, liquid economy that has 7% plus GDP growth, but also the critical, interesting thing about the Indian market, and we're starting to incrementally see this in Japan in some interesting ways as well, you get very, very large inflows from retail investors every month into the Indian equity market. And so the bottoming of the overall market is backstopped by this constant inflow of funds from the retail investors onshore within India that are very likely to keep those funds within India. And again, we're seeing incrementally some regulatory changes in Japan that are encouraging the development of a similar type of phenomenon. But in a growth scarce environment, we do think India is very interesting.
And in Indonesia as well?
Indonesia is. I think you have more.
I mean, what are some of the regional allocations that you would make on the back? You know, some of the countries that you would recommend that would circumvent the volatility that we might see next year?
Yeah, again, it's expectations versus reality combined with positioning data to understand market structure. And so the two markets that we're most overweight right now would be China and India. China, very little, almost non-existent from the holding perspective.
Yeah.
You are seeing incremental fiscal thrust being pushed into the marketplace. You've seen very, very strong performance from certain subsegments of the Chinese economy and stock market on a year-to-date basis, and we think that will continue moving forward into next year. India, a medium to long-term structural growth story that we think will remain in place for some time.
Jenny, do you think China has turned the page in terms of getting back investor confidence, and do you think that Chinese fixed income is likely to have more luck in the coming year?
In fact, China fixed income is probably the best performing. China investment grade is perhaps one of the best performing investment grade markets so far this year. And over the past 10 years, China government bond is literally the best performing government bond in the world. Now,
what about high yield? What about property?
High yield is bad. It's just really, really bad. But
property
when people
say, do not touch property, Chinese property at all.
No, not the case. Because again, in the past, since 2008, right, as we said, China is the same thing. Because if you see how much China government bond has come down and how easy to get financing onshore, of course, that push up all the property leverage and the corporate leverage. And then now we're in the balance sheet repairment stage, and all the weak companies that are already dead, right? So it's very unlikely to have another high default rate as we've seen over the past 2 years. So now again, back to what we have been talking about here. No matter it's equities or credit, pick up the ones that do your fundamental work, understand what you're investing, and pick up the good quality ones. We like some of the names not because they are Chinese property, it's because they're good credit, right? So even in a down cycle, Chinese property will continue to be in a down cycle for at least another year, if not two. But only in a down cycle, particularly for a credit person like me, only in a down cycle you can pick up the really good credit.
Right.
Yeah.
Right. Okay, I was just getting some cues from my producer. We need to carry on with some more subscriber questions. We have Vinny from Colorado who's asked our panel about what a diversified portfolio for 2024 would look like. Brian?
Yeah, so for us, I mean,
typically it's a 60-40, right? Equities 60-40, fixed income.
I don't really believe in 60-40, but not because I think 60-40 is bad, but you have to create for the environment that you're given at the time, which is why we chatted earlier about owning no fixed income I mean, for quite a long period of time, because we didn't feel we were being compensated for that, the risk basically, and we had no need to own it. We weren't forced to own. But for next year, I mean, very briefly, we're about 50% invested in equities on a net basis, slightly higher gross, but it is hedged back. We have about 20% of the portfolio in fixed income. As I mentioned, about 6 to 8% in gold. And then the balance is in either cash itself or synthetic cash that's created as a result of hedging the equity portfolio.
Fixed income, what would a diversified fixed income portfolio look like, Danny?
We really think that Asian fixed income will offer the best diversification for our clients, because Asian fixed income, if you look at the beta, this is the US, and if you look at the local currency government bond, beta to US Treasury has come down significantly. So if you really want to diversify, you need to have the beta lower than your normal or your core portfolio, right? So Asian fixed income, including both local currency and the high yield.
Got it. William from US, James is asking if Asia is expected to outperform the US in the coming year.
Yes. Well, let me temper that a little bit. China, India, with a smattering of Japan, yes. We do think we have the potential for a slowdown in some of the North Asian economies that have outperformed this year, so particularly Korea, Taiwan. There's elements of the tech space which are critical to Korea and Taiwan that we think will be interesting as we move into 2024. The price increases in AI, is AI interesting? Absolutely, and we can talk about that at length.
We will be.
Is that really in the price right now? Oh my God, you betcha. And so we're not that interested in the AI space right now, but we are seeing a turn in the cycle in AI PCs and certain elements of the semiconductor space, despite some strong performance in semiconductor stocks in 2023.
But the China AI story has been a bit underwhelming, right? The focus has so much been on US AI and all the R&D that's going into AI development stateside. Isn't that an opportunity?
It is, but I think you have to be selective. If you look specifically at some of the training programs that are being run by some of the larger Chinese internet companies in particular, some of the results have not been as impressive as some of the things that we've seen out of the United States. So we held our 11th Global TMT conference in Hong Kong last week, and we had a whole range of AI speakers. One of the speakers was referencing a recent academic survey that was done that indexed countries around the world based upon their AI achievements. The US was indexed at 100. China, interestingly, only indexed at about 51. Singapore was next, below that, interestingly enough.
Right.
And so the gap between actual mathematical achievement of AI applications and training mechanisms in China versus the US is still quite large.
Okay, that's very interesting. One more question. Our next question actually is from Jean. Jean has written in from the US saying, what is the ultimate and most profitable AI stock to purchase? Go for it, Brian.
That's a very difficult question. Obviously, looking backwards, I would say NVIDIA has been the most profitable AI stock to have owned, which we don't own. But for better or worse, worse looking back in time. I think going forward for us, I mean, we tend to invest in companies where we really understand the fundamentals, and we aren't taking, at least we feel that we aren't taking 0-1 bets. So for us to play the AI space, if we want to phrase it like that, we're much more likely to own companies like Microsoft, for example, like Alphabet, or like Baidu, and not the small to mid-cap players that may kind of surprise and take the world a bit by storm. So for us, at the moment, I mean, in large part to James's point about how expensive valuations have gotten in that space in general, we're quite comfortable kind of playing it in a more traditional way.
But if it's the gift that keeps giving, why wouldn't you buy NVIDIA even now? Why wouldn't you buy Microsoft even now at these levels?
We own Microsoft, and I mean, despite the valuation, still quite comfortable.
So you're in the money, but if
owning
somebody wanted to get into Microsoft right now as well, it's a roaring story, right? Compounding because of what may come by.
It is,
on account of their investment.
No, absolutely, absolutely. For us, it's all a function of balance. If we didn't own anything in that space, we would absolutely advocate investing in the space. For NVIDIA in particular, taking nothing away from the company, obviously reporting yesterday phenomenal growth numbers.
Hitting it out of the park.
But expectations are exceedingly high, and we just don't feel like we're being compensated enough to take risk there. It doesn't mean that the story won't continue to run, but from a risk-reward standpoint, we just prefer to take that risk elsewhere.
Okay, I did see some excitement in the audience when it came to AI, when I was discussing AI as well as other related themes. So are there any questions that you have for our guests from the audience? Okay, yeah, please.
Hi everyone, this is Kenneth from Hong Kong. So I have a question on credit. So you guys mentioned Asia, U.S. credit. Brian mentioned allocating 20% to the U.S. Treasury. Jenny mentioned adding duration to the portfolio. But you guys mentioned more on the high yield or investment grade side. So my question is on the trend of private credit. So there's a trend of private credit. It can be adding the risks to the economy, or even I want to hear how you think about adding private credit to your portfolio.
I was hoping to hear an AI question, but never mind. Private credit, Jenny.
Well, the difference between private credit and public credit is liquidity at the end of the day, right? So it's so no matter it's what credit is, you need to do, again, coming back to what it is, focus on the fundamentals. Now, the good thing about private credit is you don't need to care too much about market risk, mark-to-market risk. But also you will have to be committed, you commit your capital for much longer period of time so as to realize that yield. But overall, yes, I mean, adding private credit to a portfolio can serve a certain purpose. And it's booming here in Asia, the private credit.
Are you seeing a lot of retail interest coming into private credit?
On the retail side, not yet. But definitely there's a pickup of interest from local investors. Which is very rare.
Because there was all this talk about democratizing essentially alternatives, right? Private equity investments. I was wondering whether and that's I think primarily where the gentleman is also asking his question.
Yeah, we're definitely bullish on the private credit here in Asia. Again, having said that, because the Asian economies, for the first time, they can fund their growth and the long-term capital need from their own capital market now, and the private credit market it's one of the core market that every country is going to develop in. So this creates a lot of opportunity for like Allianz GI. Yeah.
Okay, we do not have any more questions from the audience for now. So did I see a hand go up? No, I didn't. I missed that. So we'll take up another subscriber question. Gregory from Ohio is asking, what's the outlook for Tesla with EV competition gearing up in the U.S. market? James, take that one.
So look, I'm not going to comment specifically on Tesla.
I get that.
I'm happy to comment on the overall
EV revolution, essentially.
Overall EV market in general. I think you're seeing a number of different ecosystems being built. If we look at China specifically, again, we referenced earlier in the conversation that there's been a number of subsectors achieving significant outperformance in China. China pure EV stocks are up 67%-ish on a year-to-date basis. Yeah. You're seeing very, very significant volume being pushed into the market. I was in Shanghai recently, and every other car has a green license plate, which indicates it's an EV car. And you're seeing, frankly, designs and technology that are becoming world-class very quickly. I think the challenge in the space, and this has been some of the challenge with Tesla and other share price on a year-to-date basis, is you are seeing significant discounting activity being pushed out into the marketplace, and the margin profile of some of these companies moving forward is interesting to discuss. The way we would think about it at JPMorgan is to try to understand the basic fundamentals of the business. Who can make money at a given price point? And the answer is China, and then to some degree Korea, and then really not the US at a given price point. And so that's the underlying fundamental analysis that we're most interested in. If you assume that you're not going to get massive government subsidies to encourage adoption to the same degree that we have in the past, every Uber in Hong Kong for a while was a Tesla because of subsidies, right? That's not going to happen again. Then you have to reach a market clearing price for these vehicles, and the cost of production becomes the critical variable to analyze.
Yeah, and when it comes to the cost of production, you're talking about the EV supply chain as well. The search for minerals, that go into these battery technologies, that's obviously power EV vehicles. I do want to get your thoughts on how you're looking at, if one were to look at taking exposure to the whole EV ecosystem, Brian, how should one do that?
So we actually take a slightly untraditional approach to investing in that space. One of the ways, it's really two ways. At the moment, they're both concentrated in the US in particular, but one is traditional regulated utility investments, which is in some ways a bit counterintuitive. But for the first, since the global financial crisis, you've had almost no volume growth in electricity, right? As economies have shifted more from manufacturing towards services, before the advent of data centers really taking off, right? You've had volume decline on the electricity side.
Yeah.
Now, finally, with the advent of EVs, as they become a bigger and bigger part of the car park, you'll have proper volume growth. So these electricity companies, regulated electric utilities that have been more or less ignored by the market and are trading at quite inexpensive valuations, will now actually offer investors growth in sort of the 5 to 7% range. And then when you stack that on top of a dividend that's sort of 3 to 5%, you end up with a double-digit grower very consistently at far lower risk than investing in a pure play, either battery company to date. And it's not to say that those companies aren't worthy of investment. They are as well. But for us, the risk reward far and away.
What about nickel mining businesses, copper, cobalt?
We are invested in copper and in lithium. But even there, our investments are typically focused on companies where we do the bottoms-up work. We're focused on companies that are either the lowest cost producer in the space. So what we aren't trying to do is predict copper prices 12 months into the future. I have no idea where copper prices will be over that time.
Of course you do, Brian. You're not just sharing it with us.
But over the mid to long term, right, we know that we need more copper. So if you are invested in the lowest cost producer, then that is a way to participate in the space. But really, I think there are a number of regulated U.S. utilities, like Edison International, for example, which is based in Southern California. We'll have proper volume growth that's built into the rate base, that's blessed by the regulator. So you know for certain that over the next 5 years, I'm going to have double-digit growth. I'm paying less than a market multiple at exceedingly low risk. I mean, that, in our minds, that's a great way to look at the landscape and still play the EV space.
That's interesting. So that's from the back end side. But Tesla, I mean, do you think that Tesla can continue to have its dominant position in the EV market?
I think I have a far less convicted view in that than I have in the investments on the utility side, for example, that we've made. I mean, to James's point, there are a number of competitors that continue to ramp in the space. And so for us, at least, when we've done the work on Tesla, the investment case and risk reward hasn't been compelling enough for us to invest. So we aren't invested in Tesla at the moment.
Okay, interesting. Gregory has also written in from Ohio. He's asking about the AI impact on the healthcare durable medical equipment space, DME essentially, that can, of course, have an impact on companies like Descom as well as Abbott. Now, I just want to broaden out the discussion, but the fact is that AI is going to be disrupting our lives in more ways than one. And so how are you thinking when your clients ask you about this question? And I'm so sure as a fixed income manager, I don't know whether you get these questions or not, but at the end of the day, it's top of mind. And so how do you kind of think about what AI would mean for our lives going forward? James?
So I think it's important to take a step back and level set the conversation a little bit. And look, ultimately, AI, particularly in the form of large language models, which is the conversation du jour given ChatGPT and Microsoft Fun and Games over the course of the last couple of days, LLMs predict the next word in a series, mathematically. Like, that's all they do. And that achieves some amazing results. But if I take a step back, what they're doing is ingesting more information than you or I ever could in our lifetime. So they're ingesting information at a scale that is non-human, and then summarizing it and presenting it back. If I present that in academic terms, if any of you did a bachelor's degree, my bachelor's degree was largely ingesting information and regurgitating it. LLMs are fantastic at earning the bachelor's degree. Can they earn a master's degree or a doctorate degree? That's about advancing the state of knowledge. If you're summarizing at scale all the world's knowledge, that does not give you the ability to create insight incremental to that knowledge base, in my view. So I think that's an important backstop to the conversation to level set. But that said, if I can ingest information at a non-human scale, the implications for many industries are significant. The key thing that we're looking at across a whole range of industries, and I think we had 8 or 9 industry representatives talking about AI in different panels at our conference last week up in Hong Kong. Ultimately, this is an incredibly good tool to reduce the friction of gaining knowledge. And so particularly in a services business like ours, the ability to take somebody directly out of college knowing nothing about markets and to reduce the friction of their gaining of knowledge to make them a subject matter experts in markets, you're reducing the time period within which you can accomplish that goal. And so that acceleration is critical for a lot of forecasts and a lot of different industries that we're looking at. It will be very industry specific, and the productivity gains in particular will be very specific to how the company uses AI. And that would be my closing comment on the subject would be that there's a lot of management teams that have an AI budget. And they have an AI budget because they're ticking a box. They don't actually know what to do with that AI budget. And we had a AI implementation expert on one of the panels saying he can list a whole range of companies that have an AI budget that are doing absolutely nothing real with it. And so the question is, can you re-engineer process across the entire stack of what you do as a business to take advantage of these new tools, not to have a bucket that's marked AI that sits on the side of your desk that you pat every couple of days.
Fair point. Jenny, what are your thoughts broadly on AI? I mean, I know in the context of maybe not fixed income, but the banking sector, you're talking about financial inclusion, you're talking about how the benefits from AI need to outweigh the risks, threats, right? Threat of cybersecurity and illicit funding, all of that. How are you thinking about it at a very broad level, at 40,000 feet, maybe 100,000?
Yeah, maybe even higher than that. I think from a fixed income perspective, it's actually quite relevant because we're looking for the next breakthrough in terms of productivity, and that will lead to the next round of growth, right? Because we're not, again, when we do our fundamental analysis from a fixed income perspective, for example, China, everybody's saying, oh, China is going into a deceleration in terms of growth. It will be 4% and going in the next, I don't know, 10, 20 years. But then what could change that? AI could be one of the factors, because if that story plays out, and it could create productivity, right? That will lead to a jump in potential growth. Yeah. So this is something that we're watching more from a fixed income in terms of our fundamental analysis perspective. But it's very interesting also, again, as a very passionate credit person, I must say, there's one thing at least I know that AI can't do at the moment is analyzing China high yield, because the AI must be really confused by those numbers. So we still need people. We still need human wisdom when it comes to range of outcome analysis.
But do you feel that China AI is underinvested, underexplored? Do you see there being more value there in China AI? Like what they're doing on the AI front? Because the focus, this is the point that I made earlier on, the focus is so much been squarely on US technology that a large part of what's happening with Chinese tech, and I'm not just talking about the e-commerce giants, I'm not just talking about the Alibabas and the Tencents, but really what's happening in terms of innovation, in terms of AI, R&D, is going under the radar.
Yeah, I think that there has been interest in it, but from for a whole host of other reasons, consumer sentiment, the property overhang, I think that Chinese equities in general have been passed over by global investors, which would include investments in some ways in AI. I mean, to James' point, some industries and sectors have done much better in China than in others. But I think that, but in large part, the global investment community really kind of shunning investment in Chinese equities in general overshadows a lot of the companies that are actually doing quite interesting things, including the e-commerce players.
Including the e-commerce players. I do still want to, dig a bit deeper into China, because after the Biden-Xi summit, I was reading some articles about how maybe the goalpost has shifted, maybe the overall view and perhaps business confidence investing in China has stabilized. Do you get that sense of U.S. companies based in China?
No. I think the Biden-Xi visit was incredibly important for a range of reasons, and I'll go into one in particular.
Not even from a signaling perspective?
I think it's difficult, because I think ultimately the way that I would encourage investors to think about China from a headline perspective would be this. The Chinese government is managing the Chinese economy to achieve a series of public policy goals for the betterment of China, as is their job. If I look at the way that is expressed in China relative to, let's say, the United States, China is pushing the development of certain industries, again, for the betterment of the Chinese economy and for the Chinese people. When that industry fulfills that national priority, the focus shifts. And we've seen this time and time again. The original build out of the telecom networks in China, as an example, you saw Chinese telecom stocks perform very well because they required them to ingest foreign capital to build out these networks. Once those networks were gold-plated, the next public policy goal was cheap and ubiquitous wireless data, which crushed the telecom stocks, but achieved the public policy goals for the betterment of the Chinese people. And so if that's what you're tracking as an investor and you're trying to do the due diligence to understand, okay, at this stage of development of the Chinese economy and Chinese public policy, what is the next incremental goal and how does that impact various industries very differently? So one of the uses of AI that gets really interesting is anything that achieves labor productivity, given the demographics of China. It is absolutely in the Chinese government and the Chinese people's best interest to achieve productivity goals through the use of AI to substitute labor, because there just isn't enough left. And so if we can align with those type of policy dynamics, then that has traditionally been a very profitable strategy.
Fair enough. Jenny, I want to get your thoughts in as well, because I know we've touched upon China in different aspects, but broadly speaking, the geopolitical angle to the story, right? Whether it's Javier Milei essentially saying China's out of Argentina, you know, those kind of, the whole narrative around China isolation or, you know, circumventing China in supply chains. I mean, how are you thinking about it at a very broad level when you're looking at investing in the region? Because there has to be enough conviction for that market to be active and tradable.
The summit, the President Xi and Biden summit, definitely it's a right step in the right direction. We really need to see what's the follow-ups from that. But let's go back to China itself. I also think investors need to adjust our expectations and how we look at China. Over the past 20, 30 years, China's GDP growth model has been really, really simple, right? You just channel whatever that excess saving into, you know, the unproductive investment, which is infrastructure and property. That's it. So now, and they only have one single facet goal, which is GDP growth. Now it has changed. The government mentality on policy, what they want to achieve, has changed. They have a much more balanced goal that they want to achieve. Yes, they want to achieve the common goods, right? They want to achieve, they have ESG goals. In fact, they're very, very serious about that, right? And they want to achieve common prosperity, right? And also they want to develop further upgrading their manufacturing and the high-end development, high-quality development. So all that will mean that the old model of following what the policymakers want to do, again, we may start to have to change that old investment model, right? Instead of following what the government wants to do, because they want to do a lot of things, you may not be able to follow what they really want to do. But and also the thing is because in the old model it's like a higher tides lift all boats, right? So now they have a multifaceted goals. Why don't we all need to focus on the sectors that can do well in the normal cycle, right? We need to find the companies that can go through the cycles, because we are going to see China like this going forward, rather than all the way just one cycle, one goal.
Is that really bad? I mean, China has an $8 billion economy.
Exactly.
You 4%. That's really bad. Yeah.
It's
a mature economy in that.
Exactly. So it will be mature. In fact, I personally think there are a lot of talks about China not uninvestable. And I keep saying to people, at least China credit has never been so investable, because we finally had a default cycle, and it's one of the worst default cycle. We will start to see what's the restructuring is going to pan out. So we will have visibility, transparency on recovery value. Once I have that, I would know my probability of default and my loss given default. I can properly price China credit.
They're done with the pain.
Exactly.
Okay. Time flies when we're having fun. I'm told that we have just about 10 minutes to go before we wrap up. So, Brian, let's start off with your closing thoughts in terms of, you have, of course, given us your broad outlook for 2024, but what is the advice, the investment advice that you would give to our live audience here, to our subscribers tuning in right now, watching us live? What is the advice, investment advice for 2024?
Yeah, so I guess I would say three things, and one will sound a bit like a broken record, but you need to do the bottoms-up fundamental work and decide properly how to allocate your portfolio take risk where you're being paid to take risk, and avoid risks that where valuations are too expensive. If we look at 2024 specifically, we are positioned cautiously. I mean, only 50% of the portfolio in equities, finally 20% earning what we feel is quite a safe return in fixed income. But within that equity piece, we do think that China is a market where you're really being properly paid to take more risk. And the US is quite expensive. So I would really conclude with that. I mean, when we do the bottoms-up fundamental work, we see 50% discount to valuations with 2 times the earnings growth in very simplistic terms. You know, obviously, you have to pick which companies you have the most confidence in, but that's how
those
we're
companies.
positioned.
We're at the end of the panel discussion.
Yeah.
Pick those companies.
Oh, we've chatted about some
Give
of
us
them.
3 companies that you'd like to pick or invest in.
No. So I've chatted about many of the companies in developed markets that we are invested in already. I mean, I would just pick one in China. I mean, JD.com, for example. It's on a 10% free cash flow yield, continuing to grow earnings. If you take cash out, let alone the investment book, then you're sort of sitting at a 15 to 20% free cash flow yield. So you're paying 5 times for a business that is dominant in its niche and does continue to grow and uses.
Why not Alibaba?
capital.
Why not Tencent? Why not Meituan Dianping? Why JD.com?
Yeah. I have the most conviction.
Why
in
not
JD.
Pinduoduo?
I have more conviction in JD than PDD, but to answer your question, we also own Alibaba, Baidu, Tencent.
Okay.
I mean, in our multi-asset portfolio, which is very conservative, about 10% is invested in China. In our global equity portfolio, we have 25% invested in China for 2024, which is a massive relative to the benchmark. I mean, the benchmark is only 2.5% in China.
Okay.
Yeah.
So
we're very comfortable being there.
Okay, mandatory disclosure. He's a friend, so I can push him a little. James, your investment advice for the coming year?
So I think we've touched on it a number of times during the course of our time together.
At a broad level, but really giving it down to the money question.
Yeah, which is like I think it's ultimately about. There's this mantra that the old rules no longer apply, and whether that's in discussions regarding macroeconomics in the United States or the impact of AI on technology stacks, et cetera, that's almost never the case. And if you look at it, any rule that no longer applies is a short-term victim of cross-currents that are absolutely understandable and quantifiable. And I'm talking particularly of our earlier conversations regarding the macro and the macroeconomic environment in the United States. And so taking that step to say, okay, the conventional wisdom is this, and then breaking down that conventional wisdom is, okay, what is the bet that conventional wisdom is actually asking me to take? And is there a deeper piece of analysis that I can do? So if I can understand the fact that you've seen a massive increase in labor force participation, which is starting to fall away, the combat that's occurred between monetary and fiscal policy in the United States, and the fact that that's now about to become symmetrical rather than conflicting. All of that, I think, actually provides relatively clear, actually that just sort of makes sense. Yeah. And so all of this confusion becomes explainable and therefore potentially understandable moving forward. The world looks very complex until we start to understand the cross currents. And then the environment in the United States for the past 12 months is absolutely explainable and quantifiable with very basic macroeconomic theory. This is not confusing. This is not magical. This is not the end of economics as we know it.
And you're saying that Asia is going to outperform the U.S. next year. What's the risk to that view?
There's several. The geopolitical risk, particularly regarding the conversation in China, is significant. If you continue to see a bifurcation of the global trading environment, that is a massive problem. Asia historically has outperformed, as Jenny mentioned earlier, off the back of weak dollar and growing exports. And the fact that you're seeing a realignment of the global export environment is something that we're doing a lot of analysis on right now to understand the decision tree and the optionality that exists moving forward. But that's a very real, clear, and present danger from a stock price performance perspective. I think with the election cycle that you're seeing around the region, the risk of any type of an economic slowdown triggering an increase in nationalism in a number of countries around the region, I do think is real. And one of the things we talked about earlier, and I think Jenny mentioned specifically, fiscal responsibility. Yeah. If you start to lean and get very aggressive populist policies in a number of these countries, which we've seen in the past, right? We have a kind of a case study going on in the other side of the world right now in Argentina, and we'll see how that pans out. that is a risk in Asia as well. And so particularly as we go through the next 12 to 24 months, I would highlight that as a critical risk to market performance.
I know you can't talk stocks sectorally. What do you like for the coming year?
So look, it's interesting. Again, the sectors that have outperformed this year have been AI, semi, pure EVs in markets like China. One of the things that we're lining up for next year is a return kind of back to basics. We think China airlines are interesting. We think some of the basic material sectors around the region are interesting. Extractive industries, because of demand that we're seeing, particularly from the EV and battery space, are interesting. And so the old economy tilt to market performance in 2024 could catch people by surprise.
All right, Jenny, I do want to come to you and get your thoughts because debt and deficit is going to be a big challenge, right? And we've either way touched upon the risk of defaults. But if we go by what Brian is essentially forecasting for the next year, that we don't get rate cuts, right? We stay high for longer. Then, how much pressure does that build? And I think that's James' theory as well. But how much pressure does that build really for the debt pile that we're sitting on at a time when the government, when not just the U.S. government, but governments world over are still in spending mode?
Yeah, well, the thing is, having said that, it will be naive to assume that with 500 basis points of rate hikes in a short period of time will have no impact on the economy and on the debt servicing capabilities of both governments and corporates. Today's environment, I must say, really as an investor, right, so really remind me the basic rules. It sounds really trite, but it's the basic rules of investment. One is to stay invested, because we can argue about valuation being very expensive since the beginning of the year, to be very honest, right? You need to stay invested. And as we just said, it's time to add duration in the portfolio. So stay both invested in both equities and fixed income. And then the second one is stay diversified. This is also very, very important. But where can you find the real diversification when correlation among asset classes are so high at the moment, right? So we think it's Asia. From a fixed income perspective, we think it's Asia. And the three, rebalancing. You need to be very diligent to pocket your gains, right, and to cut your loss, and make sure that you have a portfolio that properly hedged on the tail.
And what would be your best hedging strategy going into the new year, Jenny? Primarily because, Brian shared this with me. He got this data that on an average it takes about 22 months from the first rate hike for an economic contraction to come to the fore. Right? And right now we are sitting at about 17, 18 months since the first rate hike. So do we brace ourselves for the ill effects of that first rate hike in the next quarter, in the next couple of months? And if that's the case, then what's the best hedging strategy, safety strategy from a fixed income standpoint that you would want to adopt?
Depends on what's the scenario that's going to play out. I mean, we think that there's still a significant risk that has not been placed out on, not been priced in terms of, like, for example, a recession, for whatever reason. So the best hedge for that, of course, is fixed income. That will be U.S. Treasury, right? And you will be a dollar and U.S. Treasury. The second risk, of course, is there could be too much cuts. But this is more not a tail risk. This is a downside risk, more like a downside risk. There are too much cuts that's been priced in at the moment. So the best for that is to have a steepener on. And the third one is, again, because currently credit spreads around the major developed market is not offering much of a cushion. Because US IG, if you look at US IG, credit spreads at all-time tight, right? Even Asian investment grades at all-time tight. But credit carry, we still need to have that carry in the portfolio. But so you need to be in a place that you are properly compensated for the default risk and the default cycle for that carry. So again, that comes back to Asian fixed income.
I'm glad you got the final word on their outlook for 2024. Thank you very much, all three of you, James, Jenny, as well as Brian, for joining us on this panel discussion today. Thank you very much to all of you. Hope this panel discussion was valuable for you all to frame up your own 2024 outlook. Thank you very much for being a part of our live audience here. And thank you very much to all the subscribers who tuned in. Hope you enjoyed the session as well. That's a wrap on this panel discussion on this edition of CNBC Pro Talks. Enjoy the rest of your trading day.